MAA is a super undervalued REIT that at a minimum needs to be on your watch list. In today's episode, we're going to run through the company. We're going to take a look at the historical performance of Mid-America apartment communities. We're going to jump into the income statement, look at their revenue growth year on year, as well as that all-important bottom line, the net income. We're also going to take a look at their balance sheet, a very quick snapshot at their total cash versus total debt. This in turn is going to lead us into that all-important dividend safety, some very important financial metrics for the company. And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our margin of safety. Now, in my opinion, it is undervalued. We're going to look at the reasons why, and I do believe you need to have this at a minimum on your watch list. It is right there at that 52-week low, offering a very nice starting yield of 4.06%, and we can see it is down around 11% year to date, which has significantly underperformed the S&P 500, which is up roughly around 16 to 17%. However, as we know, REITs have taken a huge hit, especially with those interest rates continually climbing. Now, in terms of shareholders who have held the company over the last 10 years, you would have seen a gain just on the share price appreciation of around 118%. This doesn't include those dividends reinvested. And whilst this isn't a bad return on the previous 10 years, what we want to find out is on the next 10 years, can we see even better gains over the period if we lock in this share price along with that yield, which is currently sitting at 4% over the next few years? Can we see high single digit growth and seeing yield on cost at around 10, 11, 12%? Now, in terms of the income statement, what do we like to see? 5 to 10% growth for REITs in particular on that top line, that revenue. December 2018, around 1.57 billion on that top line. Latest annual report, December 2022, around 2.019 billion. So it has increased quite nicely over the last 5 years. Shortly, we will look at the previous 10 years percentage-wise. And when we take a look on a granular level, year on year, we can see those increases, which is positive to see. It is moving in the right direction. Now, the bottom line, the net income, what do we see? Well, December 2018, around 223 million reported on the bottom line. And the next 5 years, December 2022, nearly 3 times as much growth on the bottom line to 637 million. Now, on a more granular level, what we can see is whilst it did increase from 18 to 19, we do see a drop in 2020. However, it does then pick up and continue growing. So far, so good based on the income statement. Now, in terms of the balance sheet and a very quick snapshot of the health, total cash versus total debt. What we see here in 2018, around 34 million of cash held on the balance sheet. Latest quarterly report, they have significantly grown that cash balance at around 150 million currently. And when we compare that growth and the direction of the total debt, we can see here the total debt was around 4.5 billion in December 2018. And interestingly, it is roughly the same, slightly lower at 4.4 billion in the latest quarterly report. So they have dropped that total debt very slightly, whilst at the same time also increasing that total cash position very slightly too. So far positive in my opinion. And when we take a look at that all-important dividend safety score, 97, it is a very safe dividend, and the market cap sitting around 16 billion, making it a large cap company. Now, in terms of some key metrics, especially for those who believe we're heading into a recession, well, last recession, 07-09, they didn't increase the dividend. They just maintained it. I guess it's positive if you also believe that they would have cut it. So they have kept that fixed. Recession sales, now it was around, essentially flat in my opinion, plus 1%, which if you compare it to the rest of the S&P 500 during the 07-09 period, their recession sales were negative. So again, a positive in comparison. And when we look at the return, it was roughly in line with the S&P 500's negative 55% return from 07-09, with MAA at negative 51%. So quite a bit to digest if you believe we're heading into a recession. Now, they have been paying increasing dividends year on year for the last 12 years, and their latest increase December 22 at 12%, double digit, very positive to see. Last 5 years, 6%, again fairly positive, and the last 20 years around 4%. Now, for those viewers that are new, I do always say you want to look for a minimum of 4% growth in your dividend, salary, other income producing assets, purely based on the fact that the US inflation rate over the last 40 years was 4%. Anything less, you are taking a pay cut and losing your purchasing power. Now, our first model here, dividend yield theory, it states that a company is undervalued when the current yield sits above the 5-year average, 4.06 versus 3.19, our first sign of undervaluation. However, as always, we never look at any model in isolation and we'll draw our conclusions towards the end of the episode. Another sign of undervaluation, the forward P to AFFO ratio at 16.4 versus 21.4. And we can see in terms of the sector P to AFFO comparison, it is slightly higher at 16.4 versus 13.4. Now, I always say, even though, as we can see here, this company is towards the 52-week low, it does not signal undervaluation. Likewise, if it was sitting at the 52-week high, it wouldn't likewise signal overvaluation. Now, typically, viewers of the channel know that we tend to look at the free cash flow payout over the essential earnings payout. However, for REITs, what we tend to do is ignore the free cash flow payout due to the fact that it is more volatile due to things such as upfront rent payments, maintenance expenses and deferred financing costs. So we will look at the adjusted FFO, which stands for funds from operations payout. Now, for REITs, below 90% is what we look for, and this is one of the best REITs in terms of their payout, where it's significantly below that. In fact, for the large part, it has been below 70% consistently. Last few years, 65% in 21, 61 in 22, with 2023 at 67%. Now, the reason why I like it when the adjusted FFO is significantly lower is because it means there is room to grow that double-digit dividend that we love to see, and we are expecting an increase in the next few months. So now we move on to essentially the adjusted funds from operations per share. Again, for REITs, we tend to ignore this. However, for other companies, we would be looking at the free cash flow per share. $4.33 in 2013, $7.67 in 2022, nearly doubled, and also going the right way, consistently going up, although we do see some years where it does drop slightly, but then picks up again. More positively, 2023 is expected to go up higher to $8.37, which is very positive for investors and potential investors. Now, as I mentioned, sales growth for REITs, we tend to look for 5 to 10% year on year, and what we can see for the large part, they have done that, and in fact, some years, as we can see, 2013 to 2014 and 2017 and 2022, double digits, which is very positive. Numerically speaking, 640 million sales in 2013, over 2 billion in 2022, so very strong growth to see for a company, and hopefully we expect to see the same over the next 10 years. Shares outstanding, what do we love as investors? We love it when companies do share buybacks, returning excess cash to our shareholders. What we can see here, in fact, is the opposite. However, that is expected with REITs. We do expect them to issue shares and dilute your ownership due to raising funds for property acquisitions. Now, what we can see here, in fact, for this company, surprisingly, they have really only issued shares from 2014 to 2015, and then 2015 to 2016. Since 2017, it has been relatively flat, which is very positive because if you do look at the other REITs we analyse, they do consistently year on year issue shares and therefore dilute your ownership on a more regular and consistent basis. ROIC, one of my 7 golden dividend metrics, the other 6 are pinned to the YouTube video. Now, in terms of what I look for, around 3 to 5% for REITs, other companies above 10%. Why do I have these targets? Because those are what I believe are effective for management to able to effectively allocate their capital. What we can see here, in fact, very positive, 4% consistently over the last 4 or 5 years, 2022 at 6%. And if they continue to keep that quite high, 6 to 7%, that is very positive for investors. Operating margin, what do I look for? Well, the fact that it's consistently above 20% is very positive. For the large part, in fact, it's around 26%, 31% in 2022, very positive. Likewise, we can see the free cash flow margin. It is quite consistent, but again, for REITs, the free cash flow margin isn't that useful. Now, net debt to earnings for interest, tax, depreciation, amortization, it wasn't a real worry, the total debt, when we were looking at the balance sheet. But what this signals is we prefer it to be below 5.5, 5.5 being the number of years it would take the company to pay off all their debt net of cash on hand. And we can see from 2016 it has started to come down well below that 5.5, 3.74 in 2022, and in 2023 expected to be 3.3. So very positive, and one of the reasons why we do see that ever strong dividend safety score. Now, this purely shows us the percentage of a company's financing from debt as opposed to equity at 42% in 2022. As always, if you are enjoying the content, value is being provided, smash that like button and do subscribe if you haven't already to join this lovely community. Now, the first model we're doing is Graham's valuation model, and for these models that we are running through, if you do want to pick up this copy, do look in the pinned description below where you can run your own company through the valuation model and get your own intrinsic value. Now, for REITs, typically we don't use Graham's valuation as it isn't appropriate, but just to run it through for those who are new to the channel, what we would do for the typical company, we'd have the stock ticker, the earnings per share, the growth rate per analyst estimates with that current yield on AAA corporate bonds, giving an intrinsic value. Now, as it isn't appropriate, we won't be including it in the final intrinsic value calculation, but again, just to show you very quickly what we would do for the other typical companies. So the first model is the REIT's multiple valuation model, companies in a similar sector and size. We have Essex Property Trust, Avalon Bay Communities, Equity Residential and Camden Property Trust. Their stock price, their P to AFFO multiple on a forward basis. The average, we have the P to AFFO of MAA and their current price. So this will give us our stock price based on the REIT's multiple valuation at around $152. As we can see, upside to the current trading price and well within that 52-week range. We then move on to the second model, the dividend discount model, where we have the yearly dividends for MAA. We can see some very nice growth over the period, just under 9% for the specified period. Forward looking, I've gone for 5%, again being slightly more conservative. However, I would expect it to be slightly higher when we get the dividend increase in December. However, as always, if you want to justify a higher percentage or a lower percentage based on your own estimates and judgments, you can grab a copy of the valuation model in the pinned comments and get your own DDM and other value prices. Based on this, we're getting a DDM price of $196, showing significant undervaluation to the current trading price and above that 52-week high that we can see here. We then move on to the third and final model, the discounted cash flow model, where we have the free cash flows year on year. Average growth rate quite high at 29%. However, analysts are estimating forward looking slightly lower, around 14 to 16%. Using our discount rate, we get the present value of future free cash flows and terminal value. When we add them together with the cash, subtract total debt, we arrive at our equity value. Divide that by the shares outstanding, we get a DCF price of $168. Again, showing some nice upside to the current trading price and slightly lower than that 52-week high. Then the intrinsic value, what we're essentially getting here is the average of the three models we have just run through. And as always, if you do enjoy the content, do smash that like button and do subscribe to join this lovely community. So our intrinsic value is coming to $172 based on the models we have just gone through. Just slightly lower than that 52-week high, showing some very strong signs of undervaluation in the current market. Now, current price, as we have here at around $138, typically margin of safety, 10%, wide moat, strong financial metrics, good forward-looking data is what I would say. So if you believe that for this company, you have an acceptable buy price of around $155 based on the estimates and judgments run through today. However, if you do want a higher margin of safety, which I believe is appropriate for this company with those increasing in interest rates, drawing the price further lower, you could argue a margin of safety of 20%, which roughly is at the current price around $137 to $138, sorry. However, if you did want a slightly higher margin of safety at 25%, your acceptable buy would be around $129. Now, in terms of Wall Street, what they forecast, they believe there to be some upside to the current trading price, hitting around $163. So as always, let me know your thoughts in the comments below. Are you looking to add MAA? Are you looking to sell or purely on the sidelines speculating? As always, let me know. Don't forget to hit that like button if you've enjoyed today's episode. Subscribe if you haven't already. Catch you on the next episode and take care.